let's start with this question. Then we're going to move into how to calculate tax. And I think we'll be done with this chapter. This example is from your book. 3.18 is the number of the question. During the last year of operations, accounts receivable increased by $10,000, accounts payable increased by $5,000, and inventories decreased by $2,000. What is the total impact of these changes on the difference between profits and cash flow? So let me give you a couple of minutes. You can talk to each other, like 2 minutes. Just write down what you think, what profit is, and then, how is it going to affect the relationship between profit and cash flow? Just 2 minutes. Write it down. So, account receivable increased by 10,000. How does it affect cash? Accounts payable increased by 5,000, so cash should increase by 5,000. Inventories decreased by 2,000, which means cash flow? Okay. So what do we have? We have a decrease of 10,000 because of accounts receivable. We have an increase of by 5,000 because of the accounts payable. And because of the inventory, we have an increase. Why do you have, okay, don't, that's fine. So overall, you have the difference between profits and cash flow should be 3,000. So profits minus 3,000 should give you the cash flow, right? So it's just a general idea of how we're gonna translate income into cash, basically. Okay, any questions about these? Nothing? Okay. Then let's go to taxes. Taxes have a huge effect on every decision companies make. Okay, they have they are related to the capital structure, of course, a lot. What kind of investments to take? Say almost like every decision has some tax consequences. It's also shown in shown by academic papers as well. So we have two kinds of tax. One is the marginal tax rate. Econ people probably remember this. Marginal is basically the tax you're going to pay for an additional dollar the company generates. So from $1,000 to $1,001, this additional $1, how is it going to affect your tax? And then there's average tax rate. It's basically how much tax the company pays overall. So total tax bill divided by the total income is the average tax rate. Okay, so we know that before companies pay taxes, there are a couple of things they can do. If you remember from the income statement, you start with sales minus costs. You have depreciation, you have EBIT, then you have the interest payment, then you have taxable income. So to reach the taxable income, there are a couple of things you can use the accounting tricks. One is how to calculate depreciation. It is generally told by the accounting standards, of course. And the other one is the interest payments. So these two things are not related to cash. And these are the things you can one thing, depreciation is not related to cash, and interest is related to the capital structure of the company. So you can affect taxable income by those two things. And every time a revenue is generated, it has the company should pay tax on it. And every time there's a loss, there's a tax benefit of it. Okay? It's very common sense, of course. So let's look at two firms, firm A and firm B. They are the same firms, everything is same. The only difference is the capital structure, the financing part of the firm. Firm A and firm B, they both have earnings before interest and taxes as 100. Okay, so this part is the same for two companies. A has some debts, okay, $40 debt. B doesn't have any debt. So B is an all equity firm. For B, remember this pi. This is the assets or the total value of the firm. And there it is part debt, part equity. So this is the equation, the balance sheet equation. This is how you can represent it with a pie chart. So for B, there is no debt. So it's an all equity firm. For A, it has both debt and equity. So if you look at pre-tax income, it's 60 for A, 100 for B. Tax rate is 35% for both companies. So net income is 39.9 for firm A, 65 for firm B. So which company looks better to you? Which company generates more cash to the investors overall? B. A or B? Who says A? Who says B? Which company generates more cash to investors? A or B? Very good. So net income can be distributed to which stakeholder? Which stakeholder can get a part of net income? Shareholders. Perfect. Interest is paid to debt holders. Okay. So for firm A generates $39 for shareholders. Firm B generates $65 for shareholders. So it looks like firm B is generating more money. But I ask for all the investors, and debt holders are also investors. So if you add the debt holders, what debt holders are getting, as you can see, firm A is generating more cash actually compared to firm B. This is important. So when you're comparing companies, you shouldn't just look at one number. We're going to talk about financial ratios later, but you should also look at those kind of things. What is the capital structure is one thing. Okay? So, okay, it was a smooth, or let's say, a small thing to know, which is very important for the capital structure of companies. Then the tax rates. So there are tax rates for different taxable incomes. Not everyone pays the same tax rate. And for instance, if you generate more than $18 million, for instance, the tax rate is fixed at 35%. And in most of the cases in the companies you looked for, the marginal tax rate is generally 35%. If you generate less than $50,000, then you're going to pay 15% tax. So there are different brackets for taxes people pay. And these are marginal tax rates. What is the additional tax? What is the tax rate on the additional income you generate? These are the marginal tax rate. And in this class, we care about marginal tax rates anyway. And we are not going to use any word tricks. We are not going to give you both marginal and average tax and, oh, use this one. If not, you're going to die. No. But you should know the intuition. We are using marginal tax rates, which affects the marginal decisions in the company, let's say. Let's look at this example. What is the marginal tax rate for a corporation with $61,000 taxable income and an average tax rate of 16.67%? What is average tax rate? Average tax rate is basically how much tax you're going to pay, is how much tax you are paying overall compared to your taxable income. And it says if the next lowest marginal tax rate of 15% covers taxable incomes up to $50,000. So in this example, you're generating $61,000. So you know that if you generated less than $50,000, the marginal tax rate was going to be 15%. But actually, you're at $61,000. And you don't know what the marginal tax rate is, right? So what you're going to do is you will try to calculate what this marginal tax rate should be for your company. So for the first $50,000, you're paying 15%. For the remaining $11,000, you're paying another tax rate. So it goes stepwise. Okay? For the first $50,000, you're paying 15% tax rate. For the remaining, you're paying something else. So overall, for this company, the taxable income was $61,000. And the average tax rate was 16.67%. So from here, I can calculate how much tax this company paid. Right? From here, I know the average tax rate. It's given 16.67%. And I know that this number gives me the percentage of how much tax I paid compared to my taxable income. My taxable income is $61,000. So from here, I can calculate how much tax I'm going to pay to the government. So from this equation, you can calculate 10,000, bless you, 10,000 something is paid to the government. This is the overall tax you pay to the government. So for the first $50,000, you paid 15%. You used 15% for the tax rate. So if you multiply 50,000 with 15%, you paid $7,500 to the government for the first $50,000 you generated. But you know that overall you paid $10,169. So the difference, $2,669, is the tax you paid for within the new bracket, right? From 50,000 to 61,000 bracket, you paid $2,669 to the government. So basically, more or less, for this $11,000 bracket, you pay $2,669. So from here, you can calculate the marginal tax rate, which will be equal to 25%. So basically, what you're doing is you're trying to calculate the marginal tax rate this company pays for $61,000. For the first $50,000, the company paid 15% tax by rule. For the additional one, you should calculate how much tax is paid, and you should compare it with the new bracket, like $11,000 that is left. Any questions about this problem? Okay. So basically, this is what we have. So for the first, this is for personal taxes, I think. Yes, personal income. For some predetermined level, you pay a predetermined tax rate. For the next brackets, if you make more than that amount, for the first part, you pay 15%. For the remaining part, you pay 25%. I remember when I was in US, I was paying like here, because PhD student salary, okay, 15%. But if I took a job there, I would probably pay, yeah, here, 33% as a tax if I stayed there. So, of course, this is just the marginal amounts. Like for the first part, you're paying less tax, blah, blah, blah. And on a general, marginal tax rate is higher than the average level. Why? Because for the marginal one, you're actually paying less for part of the income. If we look at the average tax rate, actually, it's gonna the summation of all the taxes you paid will be smaller. Let me show it in this example. It's gonna be easier. So here, your taxable income is $100,000, and this is personal income example. Okay, so $100,000, which means we are here. I know that for the first $32,000, I will pay 15%. Whatever I have on top of it, I'm going to pay 25%. Whatever I have on top of 79,000, I'm going to pay 28%. So it says first 3255 is taxed at 15%, then 25%, then 28%, what the graph just said. So first you need to calculate how much tax you owe to the government. So for the first bracket, 3255, you pay 15%. Then from 78 to 32, you pay 25%. From 78 to 32, in that range, you pay 25%. Then from 100,000 to 78, you pay 28%. So 100,000 to 78, you pay 28%. So from here, the total tax you pay to the government will be 22,000. So what is the average tax you pay? Compared to your $100,000 taxable income, you're paying 22,000. So the average tax rate is 22%. Tax paid to the government, the average tax paid to the government. But if I ask you what your marginal rate is, marginal rate, if you're here, your marginal tax rate is 28%. So as you saw in the example, the average tax is less than your marginal tax because of the cumulative feature. Any questions here? Was it confusing? It's actually not confusing at all. Did I explain it in a confusing way? I don't know. Any questions about this? But you understood the nature of it, right? When you have $100,000, they don't say, okay, pay 28% tax. If it was the case, you were going to pay $28,000, right? For $100,000, if you pay 28% tax, you're supposed to pay $28,000 tax to the government. No, they don't do it that way. So for the first part, you pay 15%, then 25%. Then for the last part, you pay 28%. So overall, the average tax you pay to the government is less than the marginal tax rate, actually. Okay. A couple more things. Good news is I'm not going to start the new topic, apparently. Okay. So the last couple of things, we talk about the problem of double taxation, if you remember. So we said here, when the company generates money, each income is taxed by the government. So the company pays tax to the government, and then from net income, if you get dividend payments, you need to pay income tax for that also, because it's additional money coming to you. So this is the double taxation thing. And sometimes because of that, companies make different decisions. For instance, they say, okay, let's not pay dividends. Shareholders will pay tax for it, but we can repurchase our shares. So if I buy shares from you, then you're not paying tax on the dividend payment. So in a way, if they want to return money to you, that's something they might decide about. But of course, when there's share repurchase, then you have to also pay tax to the government if you're making money, of course. But it is they can make a decision on it. So whether we should pay dividends or repurchase shares, which one is more, which one's better for shareholders? Okay, a couple more things. We forgot to talk about Alibaba. So maybe for a few minutes I will talk about Alibaba, then I will let you go. So accounting earnings are important, right? Income statement is important. And how much income is generated is important. And companies are really doing their best to meet their earnings forecasts. So companies say, okay, we believe that we're gonna our earnings will be blah blah next period, and they do their best to meet that forecast. If not, what happens? Suppose they guess their earnings per share will be, let's say, I don't know, 20, and it happened to be 19.5. What happens? Bankruptcy? You're a shareholder in a company. The company announced earnings per share was going to be 20 next quarter, but it happened to be 19.5. What happens? Stock market's reaction. Stock price will go down. It goes down. Seriously, people look at that. Investors look at that very closely. So what do CEOs do? They do their best to meet their earnings forecast. And we can say, okay, it says accounting earnings are the single most important number reported to investors. They really take this very seriously. 80% of the CEOs are prepared to decrease discretionary spending. Discretionary means they can control that spending basically, like R&D, advertising, maintenance, whatever, to meet the earnings targets. They can do it like in a normal way, or they can do it in a shady way. These are the shady ways. Revenue recognition is one thing. So firms record a sale when the sale is made, not when they take the money, right? So lots of companies actually can use this, and they can time when the sale is made, even if they don't take the money. So they can inflate their profits. Think about those. End of the year, it is December, very important, and the end of the year numbers will be reported. What can I do? Like on 20th of December, I can tell my friends and say, just buy whatever I have. You can return it within 30 days. Just return it after January 1st. So I'm going to make the sale, inflate my profit. I didn't take the money, right? So that year, my profit will look really good. I made the sale. But then, in January, they're going to return all the products to me. It's fine. I saved this year. So that's one thing, revenue recognition, that companies can use. There's cookie jar reserves, and we saw it in Freddie, in the case of Freddie. So companies put money aside for unexpended expenses, let's say. Like banks do that for bad credits. So there are, 2-3% of the loans, they're not going to come back. They know that, and they put seriously, it's like a cookie jar reserve, and they keep that money there for bad moments, basically. And for Freddie, if you look at Freddie, their numbers were very steady for a very long time. But apparently, they were overstating cookie jar reserves. So they just used the cookie jar reserves for a couple of years. Even if things were really bad, they survived. But what happened in 2008? Exploded, like biggest problem ever. So companies can also do that. Another thing is off-balance sheet assets and liabilities. There are some things they're liabilities, leasings and stuff. They don't reflect it in the financial statements. They put it in the footnotes. So they're off-balance sheet assets and liabilities. And as investors, if we don't pay attention to those footnotes, the companies can look like they're okay even if they're not. And we have this with Enron. Enron had lots of off-balance sheet liabilities. But of course, everything looked fine for a while, but then again it exploded because it wasn't sustainable. The last thing is mark-to-market accounting. We know that assets and liabilities are recorded at the historical cost, but actually for some items, actually market values are more important to be valued at, like patents, trademarks. You don't know what their true value is, what the market puts value. So CEOs also can play with those numbers. What is the historical cost? They can just bend those numbers a little bit. So any questions here? Okay, just since you read it, let me just talk a little bit about Alibaba. So basically, Alibaba, you saw the owner. He was just like a smart guy who saw an opportunity and jumped into it. It's an online commerce company, right? There were three important places. One is what? You probably read it more carefully than I do. But there's like an online shopping thing. He doesn't take they don't take any fees from the merchants, but merchants pay money for advertisement. So their products will be seen first. There's Tmall. What is Tmall? Remember what Tmall was? Well, it was like eBay. Thank you. And there is also the new PayPal kind of thing, the money transaction part. You're very good. Yes, Talipay. It's very, very good. So basically, this guy, it was a private company. had a very profitable business, and he decided to go public. Why? To raise more money. And in the IPO, initial public offering, the price was set at what? You know it better. $60? Huh? 68. So they start with 68. I think within the same day, it jumped to 90 something. This is what happens in every IPO, by the way. This is not just Alibaba specific. They generally undervalue the price, they undervalue the stock, so that lots of sales will be made. And then they work with an investment banker to figure out what the number should be. Okay, and people made tons of money. And if you watch the Wall Street animation, I think it's like third place or so. The market cap of Alibaba now is 220 billion, which is just after Google and what was it? I think maybe it's just above Facebook. Bigger than Facebook, worse than Google, but he made tons of money. And not he, but the company, he has about 10% of the company, the owner. So he made lots of money. Also, he decided where to list the company, and he decided to choose New York Stock Exchange, not Hong Kong. We talked about last time, I think, right? I think you said something about it. They can also listed in Hong Kong, but he didn't, because from the Wall Street article you probably saw, the ownership structure was kind of, let's say, not as very good for a public company. He had a lot of control over different things, within different investments of the company. So he couldn't list it in Hong Kong Stock Exchange, which is fine for him. He put it in New York Stock Exchange. And now it's a public company. He can do a seasoned equity offering if he wants later to raise more money. But now I think he's the richest man in China now. With top 3 for sure. Huh? First? Okay. So, do you have any questions about Alibaba, how things worked out? I wanted to do the company information homework because I wanted to go into finance pages and look for numbers. We're going to do it one more time. When we do the financial ratios, I will ask you to find financial ratios for the same companies as well. And then you're going to be done with those companies. And I will assign you a homework related to chapter 3 due next Friday, and we're going to have the first recitation hour on Friday at 8:40, and 9:40 we're going to start the new chapter. Any questions? Have a wonderful Bayram holiday. Just relax. See you later.